Um, Good afternoon, everyone. It gives me a great pleasure in welcoming Mr. Vaidialingam of Ministry of Railways to CLSA Investor Conference. Mr. Suresh Prabhu, the Minister of Railways, could not attend or could not make a presentation because he had to attend, some urgent cabinet level meeting with the Prime Minister. But we are fortunate to have Mr. Vaidialingam, who heads the financial services cell of the railways. And he directly, works, along with Mr. Suresh Prabhu, the minister. So, we will request him to speak, on behalf of the minister and talk about the future growth plan, the investment plans, of the railways. So, over to Mr. Vaidialingam.
At the outset, let me profusely thank Mr. Mahesh and other organizers of CLSA to have given this opportunity to share with all of you the vision and mission and the ambitious plan the Ministry of Railways under the dynamic leadership of our Honorable Minister, Mr. Suresh Prabhakar Prabhu. Thank you very much. But unfortunately, as mentioned by him, the minister could not come here because of the emergency cabinet meeting, and therefore I stand in front of you today to tell you how this 150-year-old the monolith organization, Indian Railways, came into being in the year 1853. You all must be knowing, and it is such a one of the oldest institutions spanning almost 3 centuries. This organization has done well all these years, and it has been the backbone of the Indian economy. It has been the growth engine for the Indian economy all these years. But today, when the country wants to grow at the rate of 8%, the GDP is to grow at 8%. The infrastructure sector has to go at least 10 to 12%. Then only the GDP can grow by 8%. If you take the infrastructure sector of this country, the road, air, water, and rail, they constitute the major four. And while the other sectors have grown quite impressively over the years, the kind of growth that the railways should have also achieved the last 2-3 decades was not that much. There has been, I won't say a stagnation, but that the kind of growth that required to happen did not happen. See, for instance, when an organization like railways, which is a very capital-intensive investment, is involved, it needs a huge amount of capital investment year to year in a period of 5 years. If that is true, some certain high-value projects have to be completed. If those funds are not forthcoming, not only that really results in cost overrun, but also huge time overrun. But therefore, when this government took over, one of the focus area for this present government is that the infrastructure sector should be given a boost, and particularly the railway was chosen as one of the key areas where a huge investments have to happen, and it has to catch up. Traditionally, if you take railway has been investing in projects for a variety of projects, and for an organization like railways, which carries about 30 million people in a day. For some of you, it may be a huge number. We carry on Australia every day. Indian Railways run 20,000 trains in a day. 20,000 trains in a day. Indian Railway carries 1.2 or 1.3 times the whole population in a year. Indian Railway carries almost about 8.5 billion people in a year through these 20,000 trains. It's an unbelievably huge organization with 1.4 billion people working round the clock 24/7, 365 without one day, 1 minute. If there is a delay, you can imagine how the Bombay city would go for a toss. It has been happening on and on and on and on for 150 years. It will continue to happen in a more efficient manner. So for this kind of, this kind of thing, but there are certain skewed kind of thing. 70% of the trains give only 30% of the revenue. 70% of my trains carrying the passengers give only 30% of the total revenue. The 30% of the trains which carry the freight give 70% of the revenue. In other words, while the passengers are carried at a sub-cost level, at a highly subsidized level, our freight has been increased over the years so much so to compensate the loss. Now we have lost quite a chunk of our freight traffic to the road. The road is able to, their price is elastic. Whereas our freight and fare changes take place annually through budget. We are not so, as of now, things are going to change shortly because it is not as much a market-driven fare and freight structure as compared to the other sector. Even take airlines. Festive season, they jack up rates, and lean season, they give you fabulous discount. That kind of a thing is happening. Road, of course. And, this kind of regimentation, if I'm permitted to say so, as is one of the factors. The second factor is, the investment of an organization like this has to come from various sources. Traditionally, railways investments in, track, expansion network, signaling system, in bridges, workshops, rolling stock, all this had to happen only through the budgetary support funds given by the Government of India. That is a major chunk. And a little bit of internal surplus that we generate, which has been over the years, has been thanks to various reasons, it has eroded. Some marginal surplus we generate. Our operating ratio is about 92%. That means in a year to year, we about 8 to 9% only surplus. This is all the money we have been using for expansion of our network. But that was not good enough. Indian Railways, rail energy is 6 times more efficient than road energy. And it is, when the whole civilization is talking about environment, green energy, railway should be the driver because I am 6 times more efficient than a road, a dozen times more efficient than air, and so on and so forth. Therefore, the investment has to come in a big way, and the lost traffic from the road has to got back into the railway system, and for that, the expansion has to take place. This is one. The other, India trying to emerge as one of the superpower in financial power is, in terms of coal mining. You must have heard the coal minister talking to you the other day. He said that today we are mining about 600 million tons of coal. Is going to go to something like 1.5 billion. That means 3 times, little less than 3 times, 2.5 times, let us say. It is going to grow, we are going to mine more by 2020, by the year 2020. Who is going to carry this 1,000 additional, or not 1,000, or 800 million tons of additional coal? Who is going to carry? Road can carry? No. Rail has to carry. Steel ministry. Steel today, we are producing about 80 million tons in India. The steel ministry says that by 2020 or 2022, we would produce something like 400 million tons, 500 million tons. If 80 million tons will, end product will go to 300 million tons. The raw material for steel production is another 200 million tons. So there's going to be a quantum leap in the movement of the iron ore and the finished products. Who is going to carry that? The railways. And these two, high volume, low value. In terms of value, the freight is less, but volume is humongous. Who will carry? Only railway can carry. But is the railway prepared? Is it ready to carry this kind of the growth that the other sector is going to offer? That's the question. If that has to, the answer has to be yes, then what is the preparedness? Is it available railway infrastructure sufficient to carry this kind of the growth story that other ministries are planning to enact? These were the questions that were confronting the minister when he took over as the Minister for Railways a year back. When the 2015-16 budget, when it was framed, these were the questions that was stared at us. And this is the kind of a thing we are not ready. Even the existing, today, Indian Railway carries about 1.1 billion tons of freight, right? 1.1 billion, to be very precise, 1.16 billion tons of freight Indian Railway carry. I have to touch 1.5 billion, that is 1,500 million mark I have to touch in the next 3 years, so that railway can be relevant to the economy. Because the growth will happen elsewhere and railway cannot carry that, that growth will be a stunted growth. Therefore, I have to carry. But then which are the routes, which are the areas where this movement has to take place? Already they are all oversaturated, highly saturated. There are double lines, some of them are triple lines, with the saturation capacity ranging from 120% to 130%. How are you going to carry? Even today, if it is saturated, when this growth stories take place in the steel sector and coal sector, how is railway going to do? Therefore, totally look at the incremental budgetary exercise was kept aside. Ab initio zero-based approach was adopted. And what we thought was, we need a conservative estimate was something like 150 billion US dollars unless you invest. To be precise, $142 billion. It translates to 8.5 lakh crores in Indian rupee. A $142 billion investment, if doesn't take place from now, from 15-16 to 19-20, then it will be it will not be possible to participate in the growth story of the country. This $142 billion US dollars, where is it going to come from? That is the first question. As I mentioned, traditionally the funding capex expenditure for Indian Railways is coming only from two sources. The major chunk of about 80% was coming from the Government of India support and to the general budget. The other about 15-20% was come from the internal surplus, what we generate. But that was hardly, if we had gone by that route, we would not be spending more than $40 billion or $35 billion in the next 5 years. Where is $35 billion? Where is $142 billion? Almost 5 times the investment on a year-to-year basis. It has to be invested in the railways for it to be relevant. It has to sustain its present leadership and to facilitate the GDP growth of 8%. This is the background. Now, this $140 billion, the broad breakup is about $40 billion will continue to come from the Government of India, like the budgetary support. About $16 billion will be generated through my own surplus. Government of India also has increased their contribution. They were used to give us something like 25,000 crores. That means about $4 billion per year. The 5 years is about $20 billion. But they have their own share, they have almost double. From 20 billion, it is going to be 40 billion. So Government of India is giving that double the share. The internal generation will be about $16 billion. Then the rolling stock. The rolling stock, that is the locomotives, the coaches and other moving stock, we are going to invest about $16 billion investment through loan from the market, taking a debt from the market through Indian Railway Finance Corporation, IRFC. IRFC has been funding Indian Railways for their rolling stock investment over the years in a very humble way. There is going to be a quantum leap in that, because for this expansion to happen, it is pitched at something like $3.5 to $4 billion a year. That's about $16 billion in the next 4 years is going to invest. That's about the rolling stock. Then what about these projects? The projects which are already congested, oversaturated, those lines have to be doubled, tripled, quadrupled. Some places they are going to be 5th line, 6th line have to come to, we have to carry this additional 1 billion tons of coal and then about 200-300 million tons of steel that has to move. Therefore, we have to do certain huge investment on constructing the projects. These projects are basically double, triple and quadruple lines and kind of projects. These projects are already, most of them have been sanctioned, but they're all moving, progressing in a snail's pace. And about 118 projects have been cherry-picked by the minister, and these 118 projects would be completed in the next 4 years. And for that, we don't have the money. So what he has hit upon is that, what is the rate of return of these projects? These cherry-picked 118 projects, In a conservative way, it gives a minimum of 14% of return. Indian Railways is a monopoly. Our freight we fix. What we fix, it's through a government process. While I have competition from the road for the high value, low volume traffic, for high value, low value, high volume traffic, I literally enjoy a monopoly. But what the country can pay, what the industry can pay, of course, is a limiting factor. Therefore, these projects have to be completed next 4 years, which is going to give me a 14% return in terms of present day cost, duly factoring the inflationary thing, duly factoring the dedicated freight corridor. It's another huge initiative of Indian Railways, which is a freight line which is going to come up. After factoring all that, this 118 projects can still cross the Lakshman Rekha of 14%. Why should I depend only on the government loan, government support? Why should I depend only on my internal supply? Why can't I go to the market and raise debt for my projects? Never done in the past, ladies and gentlemen. Indian Railways never done projects through debt source, to the debt source. The first time, this was hit upon. What is the cost of borrowing for railways? It's about 8.5%, 9%. When a project can give me 14% return, what prevents me to go to the market and raise funds? And Indian Railways is sovereign. And a sovereign, when he borrows, and who will not buy? And where is the risk? Hardly any risk. And therefore, to start with, he looked around and found that Life Insurance Corporation of India, LIC, which is another government enterprise like Indian Railways, they were sitting on something like $150 billion of surplus, fetching them very ordinary return. This, we said that out of this $150 billion, we thought we will take $25 billion loan from LIC. One wing of the government, that is Indian Railways, taking a loan from another wing of the government, that is LIC, a loan of $25 billion. Out of this 142, I said this $25 billion is going to come from the LIC loan. How this money is going to be spent? This money will be spent purely on those double line, triple line, and all those freight-oriented lines where this money will be gainfully invested. And when the coal ministry and steel ministry started growing up, these lines also will come up by and by. These projects, as I said, have already been, most of them have been sanctioned, and these projects would gallop now. And can a ministry, can a government body, which has been traditionally used to spend about 30,000-40,000 crores, that means about $5 billion a year. Suddenly, can they spend, about $20-30 billion in a year? Can they spend 5 times more? Spending government by money by government is not an easy thing. There are regulation, rules, and a whole lot of procedures are there. Therefore, the tools have to be improved, and therefore the whole contract management practices have been revisited. The project appraisal methods have been scientifically gone into. And that's how the amount of 400, 500 projects which have been initially identified, only 118 have been cherry-picked. And these projects are going to be not executed in the traditional, low mode of GCC mode, General Conditions of Contract mode. Like elsewhere in India, there is a concept called EPC, Engineering, Procurement, Construction mode of contracting. This is a much more, efficient mode of doing contract management. Why Indian Railway did not go for EPC before? Because every year, I do not know, for this project, this year I get about 100 crores. There is no guarantee that I will get 100 crores next year, because it's a budgetary process. Depending upon that, there is uncertainty. So mega contracts could not be floated. I could not float a contract for 2,000 crores, assuming that I will complete it in 4 years at the rate of 500 crores spending in a year. There was a lack of assurance forthcoming to spend that kind of money. With this kind of debt available for picking up, LIC says you want to take this $25 billion tomorrow, his money is yours. And at what rate? Unimaginably low interest cost. It is GSEC plus 30 BPS. 5 years moratorium for interest. 10-year interest repayment. Of course, it will be capitalized. Moratorium means it is a deferred liability. 10 years moratorium for the principal. So first 10 years, first 5 years, I can avail this $25 billion. I don't have to shell a pie. So I'm completely insulated from my repayment liability during the 5 years. I have to complete these projects during these 5 years through this EPC mode or FIDIC mode and whatever it is. And thereafter, the money, the projects will start yielding. And then after 10th year to 30th year, total 10 to 30 years. From 10th year to 30th year, the 20 years, 40 installments half yearly per year. So 40 installments, this loan along with the interest would be repaid. How much it will cost? It will cost something like 15,000 crores. That's about $2.5 billion is the repayment, including the deferred liability. And what is the kind of additional traffic that I should have to pay this 15,000 rupees of repayment? I need only 300 million. How much I am loading today? 1,100, 1,100. And the kind of additional traffic these ministries are offering is something phenomenal. It is something like another billion, another minimum 800 million or a billion tons. So what I will be additionally loading, out of that, only 1/3 of that money I will be earning from that 1/3 loading is sufficient for me to repay this loan. So this project can happen. The railways freight can almost double in 8 to 9 years, 7 to 8 years, and the growth story can happen. This is broadly is the theme. So to run through this $140 billion of breakup, as I said, the budgetary support is 40 billion, internal surplus is about 60 billion, LIC loan is about 25 billion, IRFC is going to mop up money. You must have read in the papers. The Prime Minister the other day was in London. He talked about masala bond. The first time, rupee bond has been talked about. There is sufficient interest that has been generated overseas. And in the month of January, we are going to come to the market. It will be floated in London. And to start with, we are planning to mop up something like 200 to 300 million dollars worth of funds going to be raised through this. This also is part of this IRFC loan of $16 billion. $16 billion is for 5 years. So with year to year, it will be something like 2 billion, about 12,000 crores of rupees. Out of that, about 3,000 crores will be from the rupee bond. The rest of it from, as you all know, IRFC float bonds and goes to the market, Indian market and domestic market, and also international market and mob of funds. Through that mode, it's about $16 billion will be generated in 5 years. Then through two major components, other components are state government's participation in railways. Railways, as you all know, is in the central list. It is not in the state list, it is not in the concurrent list. So, no state government, railway is always thought as central government's baby. Every state government wants a new line, they want double line, they want this, they want that, but then their contribution is almost zero. This is how it has been, the story so long. But then with the money being very limited and the aspirations of the people are growing, then we called every other day, there was Chief Minister knocking on the door of the Minister, and we said, look, there has to be a partnership. If all these aspirations are to be fulfilled, well, let us form a JV company, let it be 51% by the state government, 49% by the Indian Railways, and you identify, let the company identify the model. Because most of these new lines, which the state government want, are not double line, triple line. They are altogether a railway line to a untrodden outside the railway network, where the industries can come. There is a SEZ, special economic zone is coming up. 300 kilometers, they have to move the input, raw materials and the output to a nearest railhead. If there is a railway line come to the SEZ, closer to that particular place, how much empowerment that will take place. So those kind of a thing, why railway should do alone? Let us do it jointly. The kind of return that you are indicating, the major share, let it go to the state government. Once the railway line comes, the entire real estate in that vicinity goes up by 8 to 9 times. Therefore, why don't we announce a line? The prices will go up. Whenever a registration takes place for a sale or a purchase, let us have a cess on that sale, and that cess can come to the project. The project finance can take to that cess. This is one. And second thing is, to commercial exploitation of the new line area in terms of mall, in terms of warehousing, in terms of other logistic support, logistic parks, all that JV company can bring in. Railway will give 30% will be railway equity of both the JV company, 70% through debt, and 51-49 is the ratio state government investment, railways investment. Let us try this model. You will be very surprised to know that Already we have signed a MOU with the government of Maharashtra, 4-5 projects. Orissa government, you must have read in the papers, already they have identified about more than 7-8 projects in the government of Orissa. Telangana and Jharkhand are at the advanced stage of finalizing an MOU with the government, with the railway ministry. Other state governments are also looking around how is it possible. A couple of success stories that happen in these states can become a really kind of a eye-opener and for other states to happen. If this happens, the spillover will be tremendous, because the lead into which this the merchandise will move from this project line into the interland of the country, 80% will be Indian Railway network. The entire freight may 70% of the earning will come to the railway. The 20% will go to the project JV for them to do the debt servicing and then for their profit. Internationally, if you're speaking, the rail earning proper constitute only 30-40% of the total earning. 60% of the earning, if you take typically Japan, you take Europe, the non-fare box collection earning is almost 50-60%. In every railway station is a commercial hub. Every railway station has got a huge potential for commercial this thing. That is the kind of a thing we have not able to do so far here. So once this JV company comes, it will be a private, it can be a private players also can be a part of this company. It need not be a state central government. They can be minor party. Private investment also can come in. So the ownership can be as broad-based as possible. And interesting model with a railway line coming, the whole lot of economic activity around that line, 30-40 kilometers, let us say, will happen. All that can be go to the project, and that land acquisition will be done on priority by the state government, and the land ownership will be with the state government and with the JV company. Normally, in all railway projects, the ownership of the land with the railways. But in this model, it will be railway doesn't want any ownership. The ownership can be elsewhere. And this, so that the kind of commercial exploitation that's possible can happen with the private players, and the other stakeholders can take the leadership. This is this kind of initiative we thought we can mop up about $20 billion out of the 142. This is one component. And lastly, PPP. PPP investment in the railways is not a very big success story. There are few projects have happened already, and there are certain problems. When we unveiled our PPP policy sometime back, 4-5 years back, it did not elicit the kind of response we expected. The investors thought that all the risks are on them and all the benefits are for the railways. This is not a level playing field. This is a kind of a one-sided. Well, then we had, after several rounds of discussion with all the private players, we have now cleaned up that policy, and now it's absolutely level playing. It's more level playing than it can be. It is in fact tilted more towards the private investment kind of a thing. The risk will be equally shared, and these policies have already been initiated. There are 5 models. One is called the MGR model, merry-go-round. A mine, a power plant. The locomotive, the rake will come to the mine, collect the coal from the mine, come to the power plant, deposit it, and go back. And it will go like a merry-go-round. And it's a captive power plant can have their own land, their own rolling stock, and railway. If they want to operate railway can operate, or they can operate themselves. Only thing is the maintenance standards have to be Commission of Railway Safety Standards. This kind of a thing has hit upon a break success. This merry-go-round policy, quite a few powerhouses have now started coming. This model has been one type of a PPP. The second thing is that they said that somehow the plan, they say, we want a line. You don't have money. I'll give you the money. NTPC says, I'll give you the money. Why are you delaying this project? 5 years, 10 years is not happening. I want the line by next 2 years. It is possible or not possible? Technically possible, money is not there. Why money is not there? Government of India gives you only that much money. What is your term? You get, the government gives you about GBS, gross budgetary support. You pay a 5% of interest. You pay the same, I'll give you the same money and the same terms as the government of India gives you. You give me 5% return is enough for me. So what happens is the so-called the capital budgeting, what we are getting from the government, my stakeholders are giving me the same money, and how I will return? I will not return directly. I will return by way of a freight discount. For if suppose there is a project is about 500 crore. 500 crore, I will return to you with a 5.5% interest per year. But for what is the period? The period can be up to you. More loading you give, every 100 rupees you need to pay only 94.5. So what happens is railway gets the business and he gets the discount, and all whatever money he is able to put is going to get back with the 5% interest. The line becomes reality, power production takes place, the evacuation is faster, it's dedicated, and there is no allotment of wagon, availability of crew, all those things not there. This is customer friendly model, which is also a big hit. It is happening. The third model is annuity model. You know what is an annuity model is. This is also we have floated. There are a couple of people are evincing interest because they cannot come under merry-go-round or this for customer friendly. The third model is also is happening. And lastly is the BOT, build, operate and transfer. That is also is so far a non-starter. But certain comments, certain suggestions are forthcome. We are tweaking that slightly. So that's going to happen. So for PPP is one of the very major initiative that is taken by this present government minister, as already showing very great promises. And if this happens, then this $142 billion this will occupy a portion of $21 billion. If you add all this, 42 from the budgetary support, 16 is internal generations, state JV is about $20 billion, PPP about $21 billion, IRFC loan overseas and domestic about $16 billion, LIC loan is $25 billion, all put together is $140 billion, 142 precisely billion dollars of investment that is going to happen in Indian Railways from 15-16 to 19-20. This is the capex story of Indian Railways, and for this to happen, there are a lot of reforms have to take. The business as usual cannot do that. So what has happened was the general managers of zonal railway who had to come to the railway board for every other approval and sanction, all these powers have been delegated to the zonal railways. Now the zonal railways fully empowered to take decisions. There cannot be any excuse for a delay. This is one major thing that has happened. The second thing happened, as you all know, FDI, the foreign direct investment, this has been a thing which has been talked about, and you have read in the papers. We have this over and above this $142 billion. $6 billion FDI has become a reality. That's about, Alstom, one of the electric locomotive manufacturer in the world. He is going to put up a state-of-art locomotive plant in a place called Madhepura. Their railways is going to buy from them 800 locomotives in the next 10 years at the rate of 80 locomotives per year. And they can also export. And this is a part of the Make in India policy of government that this Madhepura is going to produce. Totally is a private foreign investment initiative. The land and then that other financial closing, everything is over. The contract has been awarded. Similarly, diesel locomotives, GE has been awarded a contract for about 15,000 crores. That's about $2.5 billion investment. That is also a contract has been awarded. That is coming in a place called Marora. This Madhepura and Marora, there's investment worth of about $6 to $7 billion has already become reality. Over and above is 142. So the private investments are going to come in a big way, and LIC is also a sort of private investment. What is LIC? All the the money of the people who have been invested, that surpluses has been gainfully employed in a sovereign. They are not investing in somewhere. When they invest in sovereign, not only the principal and the guaranteed return, which is higher than what otherwise these funds were getting, the present wherever they have invested. Even though GSEC plus 30 BPS will look damn lucrative, but then it is still higher than what LSE would have imagined to get out of this. They say that this $25 billion is not enough. It is not the end of itself. I got something like 8 lakh. That's about I got $150 billion. If you want more, that's also available. Therefore, before we look around elsewhere for generating debt, if somebody can offer a better deal than LIC, Obviously, we will look at that. So, but there are a lot of other private activities. 500 stations in India, 500 smart stations going to become a smart station. This is one of the huge area where, this private investment is going to take place. In places like Madurai, Coimbatore, Pune, Lucknow, Jaipur, Tier 2 and Tier 3 cities of India, you see the railway stations, they are in the central district, in the main place, with one floor building, with a huge yard, huge mass of land around. If I strike a model whereby I give the entire the aerial space of that area and also the land around that station for commercial exploitation in terms of commercial complexes and so on, without duly taking care of the passengers' need, what will happen is railways will be able to mobilize huge sum of money to completely revamp this station into a modern railway station comparable to any international railway stations without spending a pie, because upfront the money will come, and in return the investors will get the complete airspace, and it can happen. It is one area where we expect not less than about $14–15 billion of investment. That is the rough estimate. This policy is also in the final shape. It has been uploaded www.indianrail.gov.in. If you go, all the PPP policy, just what I mentioned, all these policies, contours, details, nuances are available. One can see. The same website also has given the contours for this, real estate development of the under 500 smart stations. That broad policy framework has also been this thing. This is the second. Then third is, accounting reform. In a government, as you all know, in a typical government department, the accounting is not accrual accounting. It is not a commercial accounting. So when investors, they come and see our balance sheet, they don't understand, the way they look at a balance sheet of a corporate. Therefore, a massive accounting reform initiative is on the card. And Indian Railway, compared to other sectors of the government are purely cash-based accounting. The accrual concept has not seeped in at all. But in railways, we have got accrual accounting in a certain way, but not in a typical way. A person who is traveling in the month of June, he buys the ticket in the month of March. Ideally, in a corporate, will take that earning for the next year, because the travel is going to take place the next fiscal, even though ticket is purchased. Whereas in our accounting, we take the cash that is coming into the system in the month of March, the previous year account. This is a kind of an example. Airlines, I'm told, they follow accrual accounting. This kind of investors, to win investors' confidence, our accounting and our auditing, accounting. Of course, C&AG is the Comptroller Auditor General of India, is our auditor, and the process is on. That is going to be a major reform. Then yet another area is that regulatory mechanism. Okay, railway is the contractee. The investor is the contractor. Investor is investor. Investor, through investor, a contractor comes. There is a dispute. Who resolves it presently? The contractee. Railway is also the part of the contract. Railway also is the adjudicator. He is also the ombudsman. So that is not considered as fair. There should be a third body. When you have promised certain kind of rights and this thing with in a PPP kind of investment, let us say, and there is a dispute, then the dispute resolution mechanism should be fair and it should be unbiased. Therefore, a regulatory mechanism is also under finalization. It is going to come in a big way. Already the concept paper is ready. We are going to upload into the public domain and elicit comments, suggestions from the stakeholders, from the people at large, and then we will tweak it and we'll go to the Parliament for amending the Railway Act, and also to introduce an act for enacting a new Regulatory Mechanism Act. This is yet another. And this productivity, 1.4 billion, 1.4 million people work for railways. That means the employees of the railways is 13 lakh employees. That means 1.3 million people. The single largest employer of the world, government body, is the Indian Railways. So what about, for fixing the productivity norm and then deployment, there is also, the regulatory mechanism will also look into that. And then lastly and more importantly, As I mentioned, every 1 rupee and spent in a passenger service, I earn only 52 paise. 48 paise, that is 50% of my expenditure is a loss. And I'm not able to correct it. I'm not able to price my product as per my cost. Why? Why? The answer is obvious, because it's a political process and the poor man travel by railways, and then affordability is a question. All over the world, government subsidizes the railway. Railway sector, you take the Euro for instance, the entire losses the rail system suffer has been subsidized by the government, because that beyond a certain limit, they cannot price. The airlines will come and take over. And railways, as I said, is six times more efficient than road. A dozen times more efficient than air. If such a sector has to be promoted for the larger good of the economy and the environment, and this kind of thing forthcome. But is it forthcoming to the Indian Railways as of now? No. Why? Because this is the product has been priced suboptimally. Internally, we are not able to do it. Suppose there is a regulator is there. There is a regulatory mechanism is there. Who is the thing? Then, well, it can happen. It can happen. It's not overnight. It can happen gradually. So one is this PPP and private investment. When it comes, there should be a proper ombudsman. That is one major thing. Pricing of the freight. Freight is very high, and that is one of the causes for inflation. If a road is able to do it X, Indian Railways do it at 2x. Why? Because I have to compensate the loss I incur in the private sector. If I have to price, 2x can become 1.2x, 1.3x. Imagine fertilizer move at 70% of the freight cost today. Iron ore moves and coal moves. How much of benefit it will go to the public? The same public who are reaping the benefit in terms of passenger fare reduction are paying elsewhere more. Actually, you are not subsidizing. You are elsewhere. You are charging him more. A balanced approach would not only make Indian Railway robust, and the internal general surplus can happen, and also the inefficient road long lead. Frankly speaking, for any movement more than 500 kilometers, why should it go by road? If rail can, the transit time of a rail is comparable to the road, if not better, it should be better. Then ideally nobody should go to the road at all. But why is not happening? Because exorbitant freight prices is not able to attract. Rather I will, and then there is no timetabling for freight trains. The passenger trains, we have got punctuality, we have got a guaranteed delivery of the transit time is there. Whereas the freight train, there is no timetabling because of various reasons. Once I have a dedicated freight corridor, this kind of doubling, tripling, quadrupling and all comes, $142 billion investment happen. I'll be able to run trains faster and then in lesser transit time than the road, and then at a cheaper cost. Once I have throughput enhancement takes place, my cost of transport will come down phenomenally. My fuel cost will come down. A locomotive, 12,000 locomotives is capable of running about 150 kmph. If I run it only at 30 kmph, imagine how inefficiently I'll be spending the fuel. Entire fuel cost can be saved, and that would come and completely, change my bottom line, my profit and loss account. So all the spin-off innumerable are there. All that can happen. So now the question is that in this entire story, where is the role? What is the role for the private sector? What is the role for the private sector is numerous. As I mentioned, that mega contracts can happen. A 2,000 crore contract can be floated, and it can be done in 4 years. Big players, infrastructure developers who don't come to the railways today, they will start coming. L&T, for instance, they don't come to the railways. Nagarjuna, then other big infrastructure, road infrastructure guys, they come because my contract size is only 200 crore, 300 crore. When I do for 2,000 crore, which is something like $300 million is the one contract, then a lot of big players will come. It can happen. So there is a huge 4 times growth in expenditure takes place, capex takes place. So that much of money will also come into the economy. And then for that, I said the EPC contract is in place. That will bring efficiency of the contract management. And then when I said about this various investment opportunities in the PPP, this merry-go-round line, and in the various other initiatives and the station development, there's a huge prospects. The private sector investment is humongous. Directly, investors may not directly come to the project. Investors will invest in stock. But then those companies whose business is infrastructure development, they will have a huge business, guaranteed kind of a business in short time. So that is the kind of thing. Already the minister is talking about 2030 vision. This 5 years is over in 2020. Then the next 10 years, the investment is going to be much more than this $142 billion. That is the kind of investment Indian Railways is looking forward. The way is clear. These projects are highly remunerative. Debt mode of funding of this project is first time tried, and it is if it is completed in time, and this growth in coal sector and the steel sector is going to materialize, I don't see any reason why this story cannot become a successful story. Thank you, gentlemen.
Thanks a lot, Mr. Vaidialingam, for a very informative presentation. So we'll have a time for maybe a few questions. So before I throw open, I just start with a question of my own. So you clearly highlighted a very ambitious investment program of $140 billion over the next 5 years or so. Can you also share with us if you have like timeline for this, as in whether it's going to be like back-ended, and how much of that can be seen in the next couple of years? Is there any sense on that?
Yeah. You see, this year, out of that $142 billion, it is first year, that is first year is 15-16. It's 1 lakh crore, that comes to about only $16 billion. 16 billion is the first year. The 142 minus 16 has to be spent in the next 4 years. That means something like next 4 years I have to spend about 30 billion. Almost whatever we'll be spending in the 15-16, that expenditure has to be doubled next year. As I mentioned, these projects which have been identified, 118 cherry-picked projects, ongoing project, another 70 new projects that are going to be, that are in the process of sanction. All of them, the detailed estimates are ready, the project reports are ready, the due diligence of the project appraisal has been done, and these projects are also double, triple line. Very luckily, this double line, triple line and quadruple line land is already available. The Britishers who ruled India, till 1947, they gave the Indian railway system to India. Why they gave the railway system? That's a different story. They wanted to take cotton to Manchester. So from hinterland, it has to come to the ports. The line came and companies were called. And whatever it is, the Indian railway came because of that. And it has done, it has integrated India. It is a great, it's one of the unifying feature of this, country. And now this investment, when they did that, they had that, foresight. They procured land much more than what is required at that time. They constructed one line, but they bought line, for instance, from this end to this end. I can construct minimum 3 lines. They procured 2 times the width of this hall. Therefore, I have land to do double, triple, quadruple lines I can do. And where 90% of the land required for this investment, very fortunately, already exists. Maybe some encroachments are there, maybe some disputes are there here and there. By and large, credible records are available, pre-independent India records, mind you. Nobody can now say, signed by some Dalhousie or some such, Brahmanic kind of a thing. This has been given to some South Indian, South Maratha railway by his, the Victorian thing. And this land has been the thing, blah, blah, blah. It's there, some yellowish, crumpled paper. Of course, we have microfilmed everything. So all that will stand in the test of court when it has to happen. But the point is, the land is available. That land is available. Therefore, therefore, whether it happen, only the earthwork, the bridges, the sleepers, the rail, the fittings, the signaling system, the OHE. These are all basically in the private sector. Sleepers are manufactured. All the concrete sleepers in the rail are manufactured in the private sector. So you look at this investment, what it will do to the Indian economy. $140 billion if you take land, I excluded, mind you. Normally in this project, land take the cake. 30-40% of the project cost goes to the land. Here, almost land is available. This $140 billion will be major chunk would be for this kind of investment. Majority will, excepting rail. Rail is manufactured by Billai Steel Plant, is the Government of India public sector. In fact, other private steel producers also now on the fray. The time is not far away when other steel players also will start supplying rail to Indian Railways. So this is, therefore, for this not to happen, I don't see any very impediment like a non-availability of land. Even DFC, for you take, dedicated freight corridor, which is happening in the eastern corridor and western corridor. To the JICA loan, Japanese have given the most, 90% of the cost of the western corridor, so Mumbai to Dadri, that dedicated freight western corridor, what we call, the major chunk is coming from JICA loan, the Japanese loan. The eastern corridor that is coming from West Bengal to Ludhiana, Punjab, that is Dankuni to Ludhiana. That project is World Bank funded. There, World Bank is not fully funding. And these two major projects are externally funded projects. When that is happening, why this cannot happen? Number one. Number two is that, the projects that is going, which are going to be invested are not, projects which are vulnerable for, one, suppose the coal does not get mined more than 500 million, let us say, hypothetically. Steel does not, this kind of extreme conservative kind of a thing, then you may say that this investment will not be able to generate that much of earning, and therefore your repayment may not happen. You may say that. But I don't see by any stretch of imagination, I can see that, a power shortage country like India, why coal will not move, why coal cannot be mined? And then most of the NTPC plants are working only for 50-60% capacity utilization. Evacuation has to be faster, and this has to happen, then certainly this will move. Therefore, decongestion is required. Decongestion, if it requires, if it happens, then this growth will come. And the regulator coming in the picture, the correction of the fare and fare will take place. In the meantime, DFC also will come. And if railway grows at 12-13%, India will grow by 8%.
We have probably time for maybe just one question. Okay, Asraj. Bharat, yeah. Go ahead, Bharat.
Sir, it's really heartening to see your capex plans and the funding actually falling in place. Just wanted to understand two key issues. Firstly, the Ministry of Power has announced fairly aggressive cost-saving targets, wherein the coal swapping saving is almost 20,000 crores, is what they claim, by reducing the average lead of coal travel. So, do you budget in your internal kind of accrual, growth, which we are looking at, this kind of probably revenue fall, which the other ministries are planning? That's our question one. And secondly, once DFC starts to come on stream, how would you share the freight traffic between IR and DFCC? Because clearly that is the most profitable part of Indian Railways, but that also has to be shared with DFCC. So is there any cutoff line wherein from that year onwards, whatever traffic goes to DFCC, or how does that work? Because they also have to service interest cost of almost 70,000-80,000 crores of debt. Thank you.
I'll answer the first question. You see, today we do an OD analysis, origin destination analysis. Certain movements are pretty well known. My transit time takes hell of a time. So, suppose the coal has to move from eastern part of the country to Punjab. I don't have a timetable train today because on the same train, in the same track, I run a freight train, I run a passenger train, I run a Mail and Express train, I run a Shatabdi, I run a Rajdhani, I run a suburban train, and a goods train, and whatnot. Now, in this kind of, I run a BMW, I run a Jatka, I run a auto rickshaw on the same road. That is why we are not able to exploit the kind of thing. Suppose you have a dedicated kind of a thing, freight corridor comes in these pockets. What will happen is the dedicated freight corridor comes between JNPT to, let us say, Dadri. The booking of the freight will be done by the Indian Railway. Indian Railway Commercial Department will take the thing. The aggregation can take place at that particular point in time. But the stock that will ply on DFC cannot be Indian Railways stock, can ply. But their stock cannot probably ply on Indian Railways. Those are all the kind of issues, technical issues. We are addressing that, and that is not a very major. So your question is that if DFC comes and robs away all your freight, what will happen to the profitability of Indian Railways? It is not we or they. It is actually DFC is a public sector undertaking under the Ministry of Railways. Instead of constructing a line under my own umbrella, I am constructing under the name of the DFC, and DFC will have only the fixed infrastructure. And whatever is the freight that I garner from the economy, whatever that moves there, whatever the track access charge I have to pay, we will determine by MOU, I will pay him that track access charge. The two costs I have to factor. One is the track access charge, that is their maintenance, their operation O&M cost, and then their profit will constitute the track access charge. And the debt servicing cost, what JCA loan and the World Bank loan, whatever they have to pay, that debt servicing cost at factor. Adding these two would be much, my understanding will be much lower than today the freight structure of Indian Railways. Because today, when I do a proper costing, as I was mentioning, my freight has no business to be in where it is today. It is actually to reach a operating ratio of 92%. And when passenger services are losing so much, to compensate that, I have kept my freight somewhere. When a DFC comes, I will, my capacity will be larger. I can be able to run the timetable trains. My congestion will already would have come down because of this LIC investment and this 8.5 lakh investment. This 8.5 lakh, by the way, this 142, by the way, it's DFC investment also is factored, mind you. DFC is not outside this $142 million. It is inclusive of this, that only. Therefore, it's too early to comment what kind of freight structure will have. The regulatory mechanism which I was mentioning about some time back, definitely they will play a role. When a timetable train, the guaranteed transit time, and a better rolling stock and faster disposal when it takes place, the freight that should be charged should reflect the market capacity. If I can't keep a freight like Indian Railways keeping like that and then expect the DFC to be successful, therefore a regimen may come. If you want to run by DFC, X is the rate. If you want to run by the Indian Railways, X minus Y will be the rate. So that is kind of a differential pricing. If you want like a faster train and a slower train, that will happen. The second thing is that the container is going to we are handling very minimal share of the container traffic in Indian Railways because capacity to handle container is horrible, and therefore the container traffic which should have blossomed and bloomed and grown in a huge way, that has not happened. One DFC comes, that is going to be a double-decker trains will be happening. In Western Corridor, there will be one container sitting on another container. The overhead equipment will be on above that. It is a double-decker container can handle. So the double the tonnage of one train can actually carry double the time of thing. All these are all the pluses. So eventually, how it will be, the freight will be structured, how it will benefit the stakeholder and without harming the Indian Railways profitability is something we have to work out. It's too early in the day to comment on that. But it is not an impossible task. There a balance can be struck because the country needs a DFC and the freight has to move, and then the consumption points are all over scattered. There is a global village and then economy is growing, and therefore there won't be any dearth of traffic for both Indian Railways expansion program and also for DFC. The second question you asked is about regulator, right?
No, the coal swapping savings which Ministry of Power.
Yeah. So second question, see, if the mines and the power producing plant are going to be in close proximity, the kind of lead that is happening today may dwindle. So railways freight will come down. Is that the point you are touching upon?
So they are going to
Bharat, can we take this question offline because we have completely run out of time? Yeah?
Okay.
Okay.
So basically, what I would like to say is we have taken the consumption point, we have spotted all the present power points, power points, the power production points which are going to come up, we have mapped them, and the kind of, the mines which are existing today, we have plotted. And we are in consultation, not in a formal consultation, fairly well we know the kind of movement that has to happen. It has to be from eastern to rest of the country. All the mineral ores are there. It has to go to the rest of the country. Some of the plants, see, locally produce and put it in the grid. And through the grid, it can go to Punjab. Why should I carry the coal? It's a good question. But if you do the economics, actually the transmission laws and then the kind of distribution costs involved, much more than carrying, in certain example, it works out to be other way around. These economics will work out. But the congestion has to go away. This investment will decongest. This decongestion has to take place. How decongestion will be utilized by coal sector, by other sector? See, it is like this, egg or the chick. First, infrastructure is not there, therefore economy is not growing. First, you create infrastructure, the economy will reinvent itself, then the things will happen. Therefore, you can't, before you create the infrastructure, you can't count the chicken. You have to, these are all capacity constrained areas. This is a hardcore freight areas. Produce the capacity, industries may come, once the timetable train is there, once the DFC is there, then who knows, some of the manufacturing plants will come just because the railway infrastructure is available. It can be a multiplier effect. It can itself can be a trigger for the growth of economy. So today what the coal ministry is saying, and it means the starting point. This is not by an end in itself. This is only a beginning. The growth story can totally take a different, tangent altogether as things happen.
Absolutely. We've completely run out of time here. Thank you very much, Mr. Vaidialingam, for a very informative presentation, and thank you very much for attending it. Thank you.